Well, there, Canadian wealth secret seekers. Today, we're going to be digging into, I'll be honest, we often say we're not big fans of the word retirement. However, there's a few things on our mind when it comes to building our wealth. And typically, it comes down to having time freedom, having the income, that passive income coming in so we can do what we want, when we
Hmm.
want, where we want. And also, something else that people are often battling is, what should I be doing to sort of plan for my estate? And we're going to have some
Hmm.
episodes in the future about estate planning and some of the realities of, when we're accumulating wealth, when we're accumulating assets, sort of like what happens later if we don't have certain plans in place. But for today's episode, we're going to focus in on this time freedom idea because I don't know about you, John, when you
Hmm.
look in the media, the word retirement's always floating
Sure.
around. So we're going to use it on today's episode. But this idea, we're going to translate that to time freedom and feeling like you're able to do what you want when you want. But we've got some headlines here. If you're watching on YouTube, I'll share the screen with a couple of these articles. But Global News, for example, has a headline: retirement becoming unaffordable for Canadians. What can they do?
Hmm.
We look at another one here as from the Financial Post. This was in February 2024. 2024, I should say, retirement out of reach for almost 40% of working Canadians over 50. And then we see another one here. This is
Here,
Bloomberg. 32% of Canadians are nearing retirement without any savings.
here's what I wonder when you read these, and I'm sure you listening right now are wondering the same thing. Is are these headlines you know out of the norm? So are they indicating that that this is a new world we're in, where all of a sudden like retirement was in out of reach for 32% of Canadians, whereas or is it historically that's been true all along, and they're just pointing it out so that we now have to like something to write about, or we want people to kind of get into the, you're reading that from a Bloomberg article, which is like, let's get someone over here to kind of start doing some investing. Like,
Mhm.
are we really talking about things that are saying like this is not this is a new phenomenon, or is this the norm?
Yeah, I mean, honestly, when we read and we see that people are in this place, one thing that we're seeing here, we don't know if it's necessarily a cause and effect relationship, but I mean, the reality is the stats show that there are less defined benefit pension plans. There's less undefined or match contribution plans out there. So ultimately, more people are on their own to figure this thing
Right.
out. And I think it really comes down to that place. Now, we do have an episode where we talk about making your own pension.
Yes.
I think what keeps a lot of people in certain jobs, specifically, like think about government jobs, anything that is funded by the government, oftentimes has that really nice pension. Both you and I, John, coming from the education sector, having that, golden pension waiting for us and walking away from that idea is a
Not anymore.
really tough thing, right? Definitely a tough thing for people to think about. But here's the flip side is that whether you do walk away from that, if you were lucky enough to maybe have a pension, or whether you are, on your own and having to do this on your own, one of the big thing that I think these articles and these surveys are showing is that we have tools available to us to recreate our own quote unquote pensions. But I
Hmm.
feel like analysis paralysis sort of, halts our
Hmm.
efforts. And what I mean by that is, you're reading things, you're seeing these articles, it's saying that we need to save more, we need to do more, we need this, we need that. But then when you actually go down that rabbit hole, probably not for the folks listening to this show because you're down a rabbit hole listening to a podcast about building your wealth and getting those time freedoms. But in general, every time you go further down the rabbit hole, you get a new problem, right? So it's like you can decide, I'm going to invest more, but then the question is
Right.
like, what am I going to invest in? And then you go
Yeah.
down that rabbit
What's the
hole. And then
balance?
even if you want to go, I was on a call about 2 weeks ago. There was a caller, listen to the podcast, amazing person, super great, is deciding to go into real estate. But then there's the rabbit hole of like, do I do long-term holds? Do I do fix and flips? Do I do BRRRRs? Do I do
Right.
any, short-term rent? All
What's
of a
the
sudden now
best
you have
strategy?
of these ideas and you're just becoming overwhelmed with the result. And really, we have this fascination, and part of it's probably ego, right? Our ego wants us to do the best, right? Like we want to pick the best thing. I want to be able to say that, look at this investment over that investment, whether it's just to yourself or maybe, with some friends at, around the campfire, and you want to, I did this, I picked that stock, I did that, whatever it might be. And when you, kind of rewind to those who either are in retirement and have pensions that were defined for them, how many of those people actually thought about what the returns were that they were getting? They paid into this thing, right? Usually the employer is matching, right? So they're two people are funding this thing, but nobody's really asking, like, what's my rate of return that I'm getting? But they do know what they're going to get at the end. And that's the part that people really like about them.
That's exactly right. It's the defined part. Like it's one of those black box things. It's like, I don't need to know what's happening in the middle here. That's the whole benefit of having the defined pension plan, is that you don't have to do any thinking here. Someone's doing that thinking on your behalf, and you're just saying, I will get that, and I am happy with that. You figure out the middle, and I don't have to worry about it. Like it's the same reason, like when you go to buy a new car and you are wondering what the interest rate is, or let's say you're going to finance the car through the car company, and they're talking about like you're trying to figure out what is the rate of the rate you're going to be borrowing at, or you're wondering what the price of the car is. And sometimes those people steer you away from the price of the car. They steer you away from what the rate of the borrowing rate is going to be, and they focus on what the monthly payment is going to be. Are you happy with a monthly payment? Because that you can visualize, you can work into your budget, knowing that, you're like, okay, I'm happy with that. But then you don't know exactly what the car costs. You don't know, like, you know what I mean? Like maybe you didn't think about all of those things. And that's what's happening with the defined pension plan, right? Is like, I'm looking down the future. I'm going to get 60% of my salary, my income. I'm happy with that. I can live on that. I'm not going to have a house to pay for. My kids are going to be done. Like you visualize that this defined thing is there, and you don't have to worry about the middle. But we talked about that on that episode that you just mentioned here about creating a pension plan that beats the gold standard. Is that when you have that, you're actually missing the growth rate of what's happening in the middle. Is like, actually you can beat that if you do a little bit of that thinking in the middle anyway.
Right. Absolutely. And it's just, I find it interesting. It's like a human psychology sort of like conundrum. It's like a paradox that, when you have this defined benefit scenario, nobody asks any questions, nobody has any issues, everybody's happy. But like, if you actually take that number, and I'm going to encourage people in the show notes, we'll share the link to our creating your own pension plan scenario. We're using a very, very, very conservative rate of return because we're using a very conservative tool that will also guarantee some of what it is. And of course, we're talking about par whole life in that particular case. But we also have another episode where we talk about looking at bonds and fixed income replacement, and also looking for, like, could we find a better fit for that portion of your portfolio? And ultimately, what it comes down to, and we've said it before, I'm going to advocate it again, is that acting on something is so much more important than trying to get it perfect. And I just find there's so much analysis paralysis that every day, month, year that goes by before taking action is, you're losing the most important part, which is the time factor for compound interest to take place, right? We need the compounding effect to actually take place. So we're going to be kind of today talking a little bit about those two episodes. The pension episode was, I believe, episode 63. And then the bond replacement episode was somewhere around there. So we'll dig it up here. Maybe we'll pull it out after. But what I want to talk to people about is just, we're going to move away from real estate for a second. We love real estate. We think it's great, but let's talk about something that people can do easily and essentially efficiently. And they could actually do it basically today. Like you can make this choice to start doing this thing. Now, we are talking about just the typical markets. We're going to talk about the S&P we're all Canadians here. Okay. I love Canada, but I don't necessarily love the returns, over the long time or over the long term. And with our new budget, I'm not anticipating that our economy is going to be the one that's going to be leading, ahead of, say, the US versus Canada, or really leading very many economies out there. So we're going to talk a little bit today about S&P, and we're going to talk about the traditional sort of 60-40 split on a portfolio, like your traditional sort of approach to retirement. Now, again, if you have a pension, you don't even care about any of this stuff because you're like, oh, I'm pretty good. But maybe you have tax-free savings, maybe you've put some into RSPs, or maybe you have an unregistered account as well that you're looking to sort of, upsize your returns a little bit and live a little bit more comfortably into retirement. So in this particular case, we're going to take a $200,000 salary. Now, this could be one person, it could be one household. It's really up to you. We're just picking a number here. And we're going to be a little aggressive on how much we're recommending that you actually invest. All right. Because as you'll know from the pension episode, educators, for example, who we always call that sort of one of the gold standard pensions, educators as they work their way up the grid, they are paying about 12% of their salary, and that's being matched by the employer or the government with another 12%. That's like 24% going into this pension. So if I'm thinking I'm only going to save 10%, like you might see, advertised someplace, hey, save, pay yourself first, save 10%. We're going to say that that's going to leave you not feeling so happy in the long run, or at least it's not going to make you feeling as comfortable as you probably want. So the number we're using here today is we're actually going to use 20%. However, John, you and I tend to contribute more to our investments. Now, we're more real estate, but again, we try to live our lifestyle in the way we choose, but we are also selective in the things we buy. So we're going to assume here that we're taking 20% of this $200,000 income. All right. Now, again, the higher the better, of course, like anything, the higher the better. But in this case, we're going to assume that's about what's that going to be? $40,000 in total. So you've got 200 coming in, you've got $40,000. Now, again, that would assume that this is going to be after tax dollars here. Okay. So we're just going to use simple scenario. We're not telling you 20% is the number. I would say as much, the highest percentage as possible is going to be the best number, right? Of course, is investing more so that you don't have to do more later, right? You can invest or you can retire earlier. You can, choose those things. But in this case, that's going to leave us with that $40,000. Now, in a 60-40 split, that's going to put $24,000 of that 40 going into equities.
Okay.
It's going to leave the remaining 16,000 going into more of your bonds, fixed income side
Makes
of
sense.
the portfolio. Okay. So this is pretty typical, pretty standard textbook. We have an episode where we talk about what's the best split, right? So Warren Buffett thinks 90-10 is fine for life. Others say 100, take 100 and subtract your age, and that gives you your equity, bond split. But we're going to use the 60-40 because it's the most common. And some would even argue that as you get closer to retirement, it should even become more like 50-50 or even less than 50% in equities. We don't necessarily believe that. But what we want to talk to you about is just this idea of how equities and fixed income actually work, because they're supposed to be uncorrelated, as we've discussed previously. But in reality, when things are bad, oftentimes they become more and more correlated, right? So especially in those black swan events, the ones that we're really trying to protect ourselves from, we're actually not seeing sort of the opposite happening. We're not seeing equities go down and fixed income popping up immediately, right? Oftentimes we see that they become quite correlated, and you might see everything go down. But tell me about some nuance here, John.
Well, I was just thinking it's like it makes sense to like to split your, the whole point of the 60-40 split in my mind is to safeguard on those events, right? Like if all of a sudden the market does a downturn, it's doing a pullback, it's doing a correction, we've got a good chunk of our assets in the bond, which aren't fluctuating as high as, say, the equities are going to be fluctuating. This is the whole reason we move from say having high equity, like you said, it's like you do the age subtraction method where, by the time you're, a little older, you're getting closer to retirement. You don't want that fluctuation. You want it more in a stable, fixed income kind of set of assets in that bond market. So that makes sense to me. And if we have that split and we have that, say, downturn, then we're safe. It feels safer. Now, what I think you're suggesting and saying is like when we have a black swan event, like if we're talking about, what happened at COVID, if all of a sudden we have a huge pullback, we're, a huge correction, and maybe we're on a recession and the market is going down. You're saying that, equities are fluctuating. They're heading on the downward trend here. And then also bonds are going to be going down as well. Because, this is a black swan event. We got this event that's kind of pulling everything down. And I think what I'm thinking about right now is like the bonds are supposed to protect us so it doesn't go down as much, but they're going down some.
Right.
They're going down some. And I think the interesting idea, maybe the idea that's maybe flawed in a way from our thinking, and maybe this is potentially why Warren's saying 90-10 as a rule, is that your bonds aren't in growth mode. Like this fixed income asset here is like not in growth mode. So when the markets are, on an upward trend, when they are in a bull run, your bonds are dragging you down a little bit. In a way, it's not allowing you to grow as much as if you had a 90-10 split and you were on a 60-40 split. And if we have that downturn, it's like, okay, well, they're going down too. But they're not going down as much. But it's like, well, what happens if we didn't, if we didn't like have the bond part? And would we have lost, or would we have gained more than we lost? Like there's an interesting idea right there to say like why we might want to go 90-10. But I think we are in a 90-10 kind of, we're not a 60-40, but I think 90-10 for us too in, say, the stock market is tough when there are other methods to kind of protect yourself and also not have this drag on what's happening.
I 100% agree. So when I look at that, and I see that, of course, in any market downturn, right, regardless of what happens, whether they do come, and that correlation sort of gets closer together or not, is that at the end of the day, it's markets will come back. But the challenge becomes is when you get to that place in your life where you start wanting to pull income from this money that you're putting aside. Like here's the other interesting part.
So retirement time, right? We're not accumulating anymore. We're now pulling from
right.
these investments to live our life.
And people in general struggle to, you've spent all this time and effort and, you've committed this capital that you've been earning to building up this stockpile. And I think a lot of times we lose sight of why we were doing it. It becomes a habit, which is good. But then it becomes, you go, wow, like, look at that. I've built up this little mountain of capital. But then people like really struggle with actually starting to spend it. Right. But in reality, we only have so much time here on this planet. So the real question has to be is, how do I ensure that, and when I say ensure, that's probably the wrong word. How do I put myself in a better position? So like you're saying, and like Warren Buffett would say, I would say staying more aggressive on the equity side makes sense when you have other buckets that you can pull to in those down years. And I think that's sort of like one of the secret sauce ideas that we're hoping to share and sprinkle with everybody here today is this idea that, rather than say, especially early in the accumulation phase, I don't necessarily need my fixed income portfolio, that part of the portfolio, to really be doing the thing, because it's like, it doesn't really matter to me right now. So I could be a little bit more growth focused, but there's going to be a time later where I'm going to start using this money, be it retirement, be it I want to take a 1 year off and go travel the world, or I just want to work less. It's totally up to you what you decide. But ultimately, at the end of the day, what we want to have is some flexibility that we can pull from different buckets depending on the situation in the market. So rather than me looking to say this, this retirement bucket, and if the markets are down, be it the equities, be it fixed income, it doesn't matter. Let's say the average is a negative that year. I want to be able to look to other places to be able to not only see a positive happening, And it can be a conservative positive happening, but I want to be able to use that
Right.
money in those years so
Well,
that those equities can return back to the way they were, right? To try to get back on track, recover from those losses. Cause like a loss,
right.
if I take a loss and then I take income, I'm making that loss worse in that given year, right? So it's like
Yeah.
I took my principal, which, if we assume every year that, the beginning of each year, you're like, well, that's how much principal I have. I don't care what it was last year or the year before that. It's like, this is what I've got. I'm going to take
Well,
X number of dollars out. It's like, I'm going to now have less principal, which means I would prefer a greater return so that I can either
totally.
replace the money I'm taking or at least stay consistent.
Totally, because it's like think of it this way. Like this is why those lost years, those down years hurt more, especially like you're saying, if you're taking money out. Because the growth of returning to those same positions has to be massive, right? Like if we have let's say we have a 50% downturn, all of a sudden you've lost 50% of your portfolio. Moving backwards, you have to have 100% gain on the new money to get
Mhm.
back to where you just were, right?
Right.
So it's like when you think about it in the long term, and in let's say the first year you retire, you start pulling money, and it's in a down year. It's like, yeah, you're pulling money that you've lost some money. Now you're pulling money. Now you have less money to still make up that, say, 100% gain to get back to where you were if you had that kind of 50% drop. So it hurts a lot more if you pull from that bucket versus another bucket. Now, if you pull from the bond bucket, it's maybe still down, but you're still hurting that way. But wouldn't it be, you're talking about, let's create a bucket that doesn't have a downturn, and it's like, let's pull from that bucket instead, because it's always on the up. It's always on the up. It might be conservative, but it's going up. Let's pull from that bucket in the place of pulling from the market bucket on those down years.
Right, right. And I'll share the screen here. I've got two they're general scenarios, general cases, but for those who are a little more visual and they want to see the numbers here, up at the top, we've got our 24,000 each year going into equities. And again, we're just talking index,
Sure.
index funds. We're not promoting the idea of stock picking. Hey, if you like to do that, rock and roll, just make sure that you've got your plan in place because, hey, guess what? Unless you're a really good stock picker, the index might do better than what you're up to. And then over here, I've got our fixed income bucket. So we're using two average rates of return. On the equity side, I'm calling it 8% on average. Some people might say, you might be able to bump that up a little on average. Bonds, we have like 3.5% ish. But again, we're looking at average rates of return. And if we could guarantee that it's 8% every year, and 3.5% every year, then there wouldn't really be a question here. Like we'd just say, okay, this is what's going to happen. That's great.
Mm-hmm.
Like now you've got a defined pension, which is awesome. You can punch in numbers here. I put in, hey, what if I pull 60 out of this bucket and 10 out of that bucket? This person's 41. Oh, so am I. And is contributing this much to these two buckets over 15 years and plans to start pulling them in year 16, which puts that person at 57. And you can see, these two buckets have accumulated, quite
Pretty
nicely
good.
up.
Pretty good.
Yeah, it's like 725,000 in the equity bucket, 335 in the fixed income bucket. But again, we're assuming that nothing bad has happened here. But when
Right.
we look at, say, even just the S&P returns, for example, we could look at like 1973, and if you start off your retirement with a 17% loss, followed by a 29% loss, that's
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 tough.
going to be hard. That's a tough one to come back from. Even though in the third year there's a 31% gain, you have not recouped those first 2 years that you have. So if you start taking income and you had those losses, you're now going to need a much greater return in order to sort of repeat or replicate some of those pieces. Now,
Mm-hmm.
the term I'm going to use here is called sequence of returns. And this is the part that is really difficult for us to be able to plan. And really for any financial advisors out there, they can't predict exactly what's going to happen, but we can use probabilities, and that Monte Carlo simulation approach will take every possible scenario based on all the historical data, based on whatever the benchmark is that you're playing with, and it'll kind of give you the chances of running out of money under certain circumstances. So, I mean, if your sequence of returns started like in 82, where you went for like almost a 10-year, a decade of green, followed by one small red and then more green after it, like you're going to be off to the races. You'll probably have a ton of cash going on, but we don't know what is going to happen. So really what we want to be able to do is we want to put ourselves in a scenario where like, how can we take advantage of something like this? Can be the S&P, it can be another index, it can be real estate. Like it really just depends on what you want to pick. But whatever that is, we just need to make sure, and those who are looking on the screen, you can see, the sequence of returns really matters. And if we knew when to put the money in and when not to put money in, then, or when to take it all out, then this would be an easy game. We just don't have that. So imagine a world where we create a scenario where instead of dealing with the ups and downs, now the S&P is going to go way up and way down in some years, and the fixed income bond market is going to go up some years and down some other years, and it's going to be a lot tighter to the middle, to zero. So that's reducing some risk. But imagine if you could get like bond like returns or fixed income like returns, and have that bucket there that's basically accumulating with the option of accessing that capital in those down years, right? Imagine that world where you could allow, let's say in 1946, where, we were down about 12%. The next year was at 0%. So maybe we still don't pull from there. And then in 48, it was almost about 0.5% down. But then we had 3-4 green years in a row. And it's like, once we have those green years, we start pulling from that bucket again and stop pulling from this other bucket that's waiting there consistently. And for those who did listen to some of those previous episodes, there is something we can do. There is, instead of maybe taking those $16,000 and putting them in to your 40% fixed income bond-like portion of your portfolio, you can allow some of the best bond managers in the world do this for you, and also guarantee that it will not go down and it will not go backwards. It'll only go up. And that is the insurance company and their participating whole life investment pool, because that investment pool is operated and it has grown much like a pension fund manages their pension. So imagine a world, we had an episode where we talked about recreating your pension using this one tool. And then we had this other world where we talked about, hey, instead of maybe bonds and fixed income, maybe a policy takes its place. Imagine if you get kind of somewhere in the middle where you can still get massive upside from the equities market. And then you sort of don't worry so much about the fixed income bond part. And whatever you were going to put into that portion, you start funding a policy. And in this case, I took the same 16,000 on the same 41-year-old individual and funded it for 15 years and then stopped. And we're actually in this particular policy's case, and this particular individual's case, that bucket has grown to about 369,000, whereas that bond bucket was at like 363,000.
This a little better.
Bucket, it's a little better. So we're not looking to blow it out of the water here. But one thing I do know is that this bucket is here and it has other benefits. So it is tax-free growth, and you're also getting a death benefit alongside it. So in year one, we added about $325,000 of death benefit. Not massive, but not that bad. My bond portfolio doesn't do that for me, right? I get the bonds and that's it. Here, I've contributed a tiny bit, and I get a big bit if I unfortunately were to pass.
Yeah. And what I love is and you know this from listening to our episodes on utilizing, participating whole life policies in the past, that like in year 10, let's say in year 10, Kyle, you've got that bucket and it's grown to $219,000. If all of a sudden you had a real estate, opportunity to buy a piece of property or put a down payment down, you could take a loan out against, that collateral. You don't interrupt any of the growth on that on that, that bucket, the bucket still grows year to year the same way as if you had, if you had not touched it.
Mhm.
And you get to say, go buy that property. And then let's say a few years later, you refinance, you pay back that line of, I said line of credit, but it's like a line of credit. You pay back your policy loan and boom, you're back on track. And you now have a property that, you don't actually have any of your actual dollars into. And you can then, hey, at year 15, you're back on track to say, I can start withdrawing from this. And what I love is that you don't need to withdraw. Like it's in this case, like in those bad years, like that's the nice part about this tool is if we have a bad year and we're in the withdrawing stage of our kind of retirement age or lifestyle, that if I decide that there's a down year on the market, I don't pull from the equities bucket. I go because of the exact the reasons we said, we go over to this new bucket and we pull from there, but we don't pull from there because we don't want to interrupt the growth. We actually just take a policy loan from there, and then hey, there's going to be interest on that. But you know what? Here's the thing that I like to think about is people have a hard time with like, wait a minute, I have to borrow that money and then wait a minute, I have to pay the interest on that. Well, you could pay the interest on that, but what's happening, right? Like think about it like this. If you withdraw in the other scenario, if you take money from your bond account or your equity account, you're not gaining the gain that year on that money, right? So it's like you've lost the potential gain in interest on the money that you've invested, or you're paying the interest. Like the interest is somewhere along the way. Like that's the nature of the money, the money market that we're in, is that the interest is either you're gaining, investment income or interest, or you're paying the interest. And in this case, if you borrow against this asset, you pay the interest, but just you're factoring that in instead of loss. And in one way, it's like the way we've talked about it too. If you're also in your pulling stage or withdrawal stage, it's possible because the huge flexibility of a policy loan is you don't have to pay that back in year one if you don't want to. If you want to pay it back in year three, let it accumulate. You know what? If you look at your numbers and if you have, I would recommend you talk to someone about this. But if you talk to your, say, wealth architect who set this up for you, they can look at the projections to go, look, you might not ever have to pay that interest back because when you die, that death benefit's going to pay it all off and leave you money for your family and in your estate. So I like this approach, Cal, is like it adds like it's a huge secret sauce in thinking about like I always, the typical standard, let me go just make sure I have a good balanced portfolio and I'm going to balance between stocks and bonds. And now it's like, wait a minute, I don't even need to have bonds because I get the same benefit. Like I get the same growth benefit as bonds, but if I use a policy and I have way more flexibility in the meantime, and that thing's going to grow even if I take
Mhm.
money out.
I know. I love that. And on the screen here, I'm just kind of goofing around as you're talking because that's exactly in my mind. Again, you get to decide how you utilize the tool, right? Like as you mentioned, you can take loans early and pay them back. If you want to buy real estate, you want to do other things. That's great. But if we just pretend for a second that this policy is only to replace that portion of your portfolio and that's part of your retirement plan and that's it. And you're like, I'm not going to touch it because I wasn't going to touch the bonds
Right.
and the fixed income until retirement. And you think about like rebalancing. So if 3 years
Mm-hmm.
in a row we have a red S&P 500,
Yeah.
I might take, in this case on the screen, I'm taking 78,000 from my policy each year. And it's not from the policy. I'm getting a loan
Yeah.
of that amount for 3 years. And I just don't touch my equities and I let the equities sort of ride. Maybe I
And you
do it
don't
for a
pay it back.
fourth year because in the fourth year, the equities market had its first good green year. And you're like, okay, great. I still don't want to touch it yet because I'm trying to make up for that loss over there. It's like rebalancing. And I could choose, if it makes sense, if there's a bunch of green years in a row, I could choose to pay off that loan balance. Or if I don't, as you mentioned, let's pretend I did it for 4 years in a row. And
Yeah.
let's say I had to do it again in 5 more years. I had to do it for 2 years in a row. And then I
Okay.
had to do it, I don't know, like maybe one more year. I had to do it like when I'm 83. Now, mind you, we're taking 78,000 here. And when I do that, and I'm doing this over and over and over again, I'm taking a massive amount of that bucket. What I'm doing is I'm allowing my equities bucket to go to the moon. So it's like you're
Right.
utilizing this other bucket here, which was supposed to protect you. It still does. And I was able to allow my equities bucket to do its thing in the most efficient manner so that I'm not, stunting its growth in a down year. And
Mm-hmm.
then I look down here, and if I make it to age 100 or
Yeah.
99 in this case,
Right.
I'm still, without paying any of that loan off, I'm still going to leave $278,000 of tax-free death benefit after that loan's paid off. And my according to this S&P growth at a standard rate of about 8%, we're looking at like 3.7 million from that bucket over there, right? I mean,
So huge. Like when you were like, oh, I'm gonna leave $200,000 to my family. Like, hey, we left some, and every year you spent at least $78,000, to live. And it sounds pretty good, especially in those last 20 years. You're like, okay, well, you know, is it likely that you might spend 78,000? Maybe. But I mean, like, but then you're saying, and we got 3 million over here.
yeah,
Because we didn't
exactly.
touch that bucket
It
for a long
it
time. It makes a ton of sense.
and
Secret sauce, folks.
it is all about what makes sense. Now we can get into the nuances too. Like, let's be honest, if all that equity money is taxable money, right? So if it's
Yep.
equities and you're paying capital gains, and we know now capital gains inclusion rate is going to be going up from 50% to, two
We
thirds.
we
If
didn't even mention the
Yeah, we didn't
tax
even
free.
talk about that stuff. We've got the tax-free death benefit over there, which is great, super helpful. But even on the equity side, is that in earlier years, if your equity portfolio is getting kind of ballooned out of control in a good way, that's a good problem to have. Might make sense in certain years to take more income in order to chop down that loan a little bit more, just because there's no reason not to. Because
That's what
again, if this is all, you have to picture it as one big bucket, but you've segmented it into two spots, and you
right.
want to take from the bucket that makes sense at the time and use it as a tool to better your situation or your position. So for
Sure.
me, whether you're a 90-10 person, a 60-40 person, if you're a 50-50 person, I don't care what you are, you should at least be considering this as an option and determining whether there is a role there. And what is the role for your fixed income bond portion of your portfolio? If you're not sure, then taking a deeper dive is probably a good fit. And I would be more than happy to do that with anyone who's listening. If you want to go down the rabbit hole of your situation, whatever index funds you've got or mutual funds or whatever it is that you're doing, let's go down the rabbit hole and let's get an understanding. So by no means are we saying that you want to do one or the other. We're saying that whatever your split is, that there is an efficient way to do this, and a way that can actually reduce and mitigate the risk even more so, while allowing you to still maximize growth that you can get from the equity market.
I love it. I love it. I think there's a few secret sauces, here. I don't think they're even hidden. We said them outright. These buckets, I think, make a load of difference. And seeing the numbers, I think we are big numbers people. And if you're listening right now and you're like, man, I got lost in the numbers, go and watch it on YouTube. Go watch and rewatch that part, because that part, seeing the numbers in that spreadsheet and seeing that, when I pull from this bucket and I don't pull from this bucket, in pulling from pulling from that bucket in a way where, I mean, you're borrowing. That's tax free money. You didn't have to pay tax on that. If you pull from the other bucket, you're going to pay tax because that's, you're going to pay tax on the gain that you had in that investment account. So it's huge to kind of think about this. And it's huge to kind of like implement it. And I think the important part is what we said at the very top of the episode, is that there are a lot of strategies out there. Pick one that you think is the most important for you. Stick with it. And I think this is a great long-term secret sauce type of strategy that, a lot of people aren't using because they're doing the 60-40 split. But you could come out way ahead if you're planning for the future this way.
And, the secret sauce that I'm going to give, we didn't even talk to our incorporated business owners, investor friends, but if you are blowing up your wealth plan inside, in a good way, blowing up, meaning you want to scale
Mm,
up your net worth inside your corporate structure, I'm going to argue that there is a even greater reason why you might consider, if you're using this tool, you want to have a closer to 50-50 split, And I would love to chat with more business owners about this. And the reason why is because that death benefit will pay out through your capital dividend account tax-free to your estate. So if
Right.
that matters to you, then it makes more sense. And at the same time, you're actually incorporating more safety for yourself. And when you think about the tax, the tax incentive of active income inside of a corporation, you could be buying the same policy that someone who's in a 40% bracket is buying that policy. So when we looked at this example on the personal side, that person's putting $16,000 of after-tax income, meaning they had already paid 30-40% taxes on a higher amount, and that's what they're left with. As a business owner, those first 500,000 of profit, you're paying with 88 cent dollars. So you are getting a supercharged policy, same policy, but you get to pay with more of your money and less money gone to tax. And you get that beautiful death benefit piece that's going to help allow you to take more capital out of the corporation without personal taxation. And of course, we do have some advanced strategies for those who do have a significant amount of retained earnings that we can assist you with as well. So that's the secret sauce for our business owners. But again, regardless of who you are and where you are in this journey, there's reasons why paying attention to some of these secret sauces can put you in a position where you have more confidence going into that time freedom and allows you to have the flexibility that you can deal with those market downturns so that you're not in a panic and you don't feel like many of those articles are citing, right? People feeling like they don't have enough money to live the lifestyles that they want. So reach out to us over at CanadianWealthSecrets.com/discovery and we'll hop on a call. It's always free. We use a free model, which is all about just helping you get to the next step in your journey. And if we help you to do that, then there will be opportunities for us to, of course, assist you in that journey at a later time. So get on a call, CanadianWealthSecrets.com/discovery.
Hey, we encourage you to share this episode with someone you think will find value in it. So if you think of someone who's, thinking about retirement, thinking about planning for retirement, because you're doing that at any stage, take a moment, hit the share button, grab that link, share it with them in a way that maybe you found this episode or you found the podcast. Share it, you could share it by texting a friend. You could share it by email. You can put it on social media. Share this podcast. We put a new Secret Sauce episode every single Wednesday. Share it. And so that we can grow the podcast and help other wealthy entrepreneurs and business owners and people just like you plan for their wealth. All right, Canadian Wealth Secret Seekers, see you next time. Just as a reminder, the content you heard here today is for informational purposes only. You should not construe any such information or other material as legal, tax, investment, financial, or other advice. John is a mortgage agent with Bricks Mortgage, license number M23006803. Kyle Pierce is a licensed life and accident and sickness insurance agent and VP of Corporate Wealth Management with the Pan Corp team. That includes corporate advisors and Pan Financial.